Don't despair amid the inevitable setbacks that all investors face, especially during a crisis in the market. If the reasoning behind the investment was sound, stick with it and it should eventually turn around. No matter how bad a crisis gets, any sound investment will eventually pay off, says Carlos Slim. Hello and welcome. In today's video, I am analyzing Coal India. With this analysis, we are trying to understand the fundamentals of the company and what are its different metrics as in terms of efficiency, profitability, valuations, etc. Current market cap of Coal India is at 82,735 crores. 3 years back it was 1,81,000 and 5 years back it was 2,29,000. So we see the value of the company in the market constantly coming down, and that's not a very good sign. We want the market value of the company to keep going up instead of going down. Current price is 134 and it's towards the lower end of the 52-week high and low band. The current price to earning of the stock is 6 times. So it's reasonable valuation, that is we are paying 6 times higher than the profits earned on each share. Book value is 60 and the current price is 134. That is price to book is around 2 times, slightly more than 2 times. So this is also reasonable for me. Dividend yield is very high at 8.94%. So most of its profits that it is earning is being paid off back to the shareholders. So anyone interested in dividend yield will go for this particular stock, but there's no growth in the investment also. But because we want both dividend yield as well as investment growth, if investment growth is not there, then or the value of the investment is not growing, then it doesn't make sense to go for the dividend yield. Instead, put it in a bank FD, earn a dividend yield, and the capital is also intact. ROCE is 73 and ROE is 57%. A very high values for a company. As always I say, you check out the individual values whenever the percentage growth rate or average of the ROE, ROCEs are more than 20%. No dilution in the face value of the share at 10 rupees. Price to cash is 20 times. This is also good, below my benchmark, but compared to the price earning, this is quite high, which signifies that although the company is showing profits, all of that profit is not getting converted into cash, at least in the latest 12 quarters. ROE has been growing at 11.4% compounded over the last 5 years. So this is a good growth rate. We want that as the company earns more and more profits, it also generates higher returns on those profits, which ultimately go into reserves. And since most of its profits it is paying back to the shareholders, its ROE growth rate is intact. Earnings per share is 22 rupees and we are paying a price of 134 for that. So that's a 6 times higher than the profit earned per share. Book value 3 years back was 32 and currently it stands at 60. So it's almost doubled in terms of book value or growth in its reserves. Number of equity shares are 616 crores in the market. OPM margin 18.8%, a very good value. I want my companies to earn at least 15%. But when we look at the growth in our investments, invested from 5 years back, 3 years back, and even 1 year back, it has always given a negative degrowth. That is 15% of degrowth over the last 5 years compounded. This is not a good sign where we want our, at one place, we want the dividends, but at the same time our value, our investment value is going down. Debt is 4,800 crores. 3 years back it was 3,000. So it has increased not that substantially. In fact, in the previous year it has dropped to 2,200 crores and now almost doubled in the recent 12 quarters. Interest paid is 647 crores, which is slightly more than 10% of the current debt. Its debtor days or collection days from its customers to whom the company has sold products on or sold goods on credit is around 54 days, which is slightly reduced from where it was 3 years back at 58. Investments are 4,623 crores, almost as good as the debt it has on its book, and a small portion when compared to the balance sheet size. So even debt is not that huge compared to the balance sheet size. It's a very nominal value. Cash equivalent is 17,472 crores. So the company is cash rich as well as has an investment of 4,600. So if we add both of these, it works out to around 22,000 crores, which is slightly more than 10% of the balance sheet size. Receivables are 21,000 crores and payables are 9,500 crores. So there is a mismatch between the payables and the receivables. Even in spite of that, it has a positive working capital of 35,000 crores, which means that it can easily pay off its current liabilities using the current assets. Net blocks have increased from 23,000 to 38,000 crores over the period of 3 years. So it means the company is investing in fixed assets, which is a good sign. Balance sheet size is currently at 1,52,000, and earlier we saw what was the market cap, around 82,000 crores. So we are getting it at a discount to its balance sheet size. Debt is very nominal compared to the profit it is earning every year, and it can pay off that debt very easily using this current year's profit itself. In terms of price and the sale per share or in totality is also very good valuation wise at 0.92, meaning the market cap is as good as the sales. So in fact it is lower than the revenue it is generating through sales. So this is also good valuation ratio. In terms of, this is a very important 3 values that we need to look for every company. Profits earned 64,000, cash earned in the last 5 years 71, so higher than the profits which I'm looking for, which is very good. And out of that cash earned of 71, free cash are 35, which is almost 50% of the cash flow from operations. So whenever these numbers are intact, I would like to go for that company. But as mentioned earlier, the only problem here with this company is that it is not giving returns on our investment. Although it's giving almost 8% of dividend yield at current price, but there is no growth in our investments, because we want both. We should not be satisfied with just 8% of dividend yield, because at the same time our investment value is going down. Let us look at how the price has changed over the last 1 year. The current price is at 134 rupees and it is above its moving averages, although not that high substantially, but very near to its moving averages. And then this creates an opportunity. Whenever it goes about 200-day moving average, that is considered bullish. Although I don't use moving average, this is just for your understanding as to how to understand where the price is compared to its average. If it has gone way above its moving averages, then it means it's overvalued, and generally I don't go into buying it. Instead I rely on relative strength index, which we'll analyze a little later on. If we look at the last 5 years price to earnings, it stands at 6.1 and its average has been around 14.4 times. So we are getting it at a huge discount to its average of the last 5 years. Although it is understandable why it is trading at a discount to its long-term average, because we saw earlier that company is not generating profits for the shareholders, although paying high dividend. If we look at the sales, we can see an upward trend in the company, although fluctuating over the years or different quarters, but we can see an upward trend overall. And the OPM margin has always been very high at around 18.7, at least in September 30th. But overall also we can see in green that, and in yellow, what are the NPMs and OPMs of the company. Let us look at few of the positive and negative points of the company. It is a debt free, and ROE over the last 3 years is around 54.95% on average, a very high return on equity. And almost 78.6% of its profits are being paid off as dividend. But the growth in sales or revenue is just 5.3% over the last 5 years. This is also considered good as far as I am concerned. The debtors have increased from 33 to 54 days. Although even 54 days is a good value, considering that I have a benchmark of 90. Promoter holding has decreased. The government has sold off its stake by around 12.73%. So this is also all right. So these are actually not even negative points for me. Moving on, let's compare Coal India with Vedanta and NMDC. None of the peer group comparison will happen in the true sense because most of these companies have different kind of product profile. But for pure comparison sake, in the terms of like to like industry, these comparisons are okay, but at least product wise, because Vedanta is into different products, Coal India is into coal, although Vedanta, all these are into mining, so basically we can consider it in that sense, but of different products. The current market price of Coal India is 134, Vedanta 136 and NMDC 107. Down it is 37.4% from its 52-week highest point. Vedanta 17 and NMDC 22. So highest fall for Coal India. This also creates an opportunity if the company's fundamentals are good. Results again are up to date till March annually and September till the quarter 2020. Sales for the entire year, or rather YOY, has seen a growth for Coal India, whereas a mild degrowth for both Vedanta and NMDC. Coal India's profits over September quarters, from September to September, has fallen by 16%. Vedanta's profits have fallen by 46%, and NMDC has gained by around 8%. So all these companies have faced some kind of margin pressure, at least in September quarter. If we look at the revenue of the entire year and compare it with the recent 12 months, almost all of these companies have seen lower growth in terms of generating revenue over March 2020. For Coal India, the recent 12 months has generated around 90,000 crores against 96 earned in March 2020. Profits also has seen a drop from 16,700 to 13,500, whereas NMDC has seen a fall from 3,600 to 3,000. Comparatively, Coal India is earning a higher profits than the other two companies. Cash wise, at least in March 2020, it hasn't generated cash, although it's showing a profit of 16,000 crores. Only 1/4 of that, that is 4,000 crores, is shown as cash. So 1 year it's alright, but over a long term period we earlier saw that it was generating cash against the profits. So that's a good sign. Vedanta's profits declared was 8,900, but cash earned of 19,200. So almost double the cash than the profit declared in the P&L account. NMDC's cash has fallen short against its profits. If you look at the price to earning, all these three companies are at a very low level. The lowest available is Vedanta at 4.8 times its profits of the recent 12 months compared to its long-term averages of 9 times. NMDC has gone above its long-term average, but Coal India is available at a huge discount to its long-term average. Price to OCF wise, Vedanta, as earlier we saw, generating almost double the cash against the profit declared. It's available at just 2.6 times its operating cash flows, whereas both Coal India and NMDC are available at more than 15 times its cash flows. If you look at the price to book, most expensive is Coal India at 2.2 times, whereas Vedanta is trading at a discount to its book value, NMDC at 1.1. So all of these companies, although high for Coal India, but they are all available below my benchmark. Profits are growing at around 4% for Coal India in the last 5 years, whereas NMDC's profits have seen a degrowth of around 10%. When we look at the revenues generated, NMDC is also showing a degrowth over the last 5 years of 1%, although nominal, but we want a positive growth rate in our companies. Coal India is growing its revenues at 5% over the 5 years and 7% over the last 3 years. Same is the case with Vedanta at 2.7 and 5.3 over long term of 5 and 3 years. Return on equity is very high for Coal India at 56% compared to Vedanta and NMDC at 15 and 13%. If we look at its long-term averages of 5 and 3 years also, Coal India has always been generating a very huge returns on its equity, whereas Vedanta's return on equity has fallen below its 3 years average of around 16.5%. NMDC's current ROE also is low at 13.45% compared to its 3 years average ROE. So both of these companies, Vedanta and NMDC, are facing a little bit of margin pressures on their return on equity. In terms of return on capital employed, NMDC is generating almost 22% and 20 and 25% over long term, whereas Vedanta's ROC values are quite low. Although these values are calculated based on profits, but we have also seen that based on cash, these would have generated almost 28% over last 3 years on average, and 12% and 14% over last 5 years, because cash is almost double of the profits. Whereas Coal India's return on capital employed is extremely high at 73% and 75% over the long term 3-year average. Return on assets is also very high for both Coal India and NMDC. So this shows efficiency in terms of generating profits on the amount of capital employed, the equity shareholders' money, as well as assets employed into the business. These are good signs. Coal India's revenues are almost 2.4 times higher than the assets employed into the business. So we want it to be as high as possible, whereas Vedanta and NMDC have not generating that much sales against their assets employed into the business. So we want it to be as high as possible. Coal India's inventory holding is extremely high against the revenue it is generating. So almost 1/4 of its against its inventory it is doing sales. So this is a very low value. We want companies to generate or hold as low inventory as possible. But depending on the type of company and the scenario that it needs to be in, that is, if it's a mining company, it may have to hold a huge quantity of inventory against how much it can sell in a particular year, and that can affect this inventory ratio. Look at the long-term inventory and asset turnover ratios to compare these numbers individually with their own previous years. Vedanta is generating almost 3 times more sales than the inventory. This is good. But NMDC is generating the lowest even in terms of asset turnover as well as inventory turnover. Profits of the total last 5 years for Coal India was 64,000, Vedanta 21,000, and NMDC 17,000 crores. And when we look at the cash, Coal India has generated 71 above its profits and 35,000 crores in terms of free cash flows. So all of these numbers are good for Coal India. For Vedanta also the numbers are extremely good. 21,000 crores of profits, but 98,000 crores of cash and 64,000 still left as free cash. So you don't understand these numbers that I am referring to? Look at my older videos in my playlist section where I have explained in detail what each of these ratios mean and how to understand them. Alternatively, if you want to learn directly from me, then you can just drop in a mail to me and I'll revert back to you. But these are very good numbers even for Vedanta. Although profit is showing very less, but cash generating is huge, even higher than Coal India's cash generation over the last 5 years. NMDC again has generated profits of 17,000, 14,000 declared as cash, so less cash compared to the profits declared, and very low free cash flows. So comparatively, I would either go for Coal India or Vedanta, both, but not with NMDC because this is a problem for me. Average PAT is 12,000 for Coal India over the last 5 years, 4,200 for Vedanta, and 3,400 for NMDC. Although all of them are in positive, that's a good sign. Market cap of Coal India is 82,000, Vedanta 50,000, and NMDC 33,000 crores. So market cap wise, Coal India is the largest. But when we look at the net worth wise, Vedanta is just a 56,000 crore company, at least in terms of net worth, whereas Coal India is 37. So it's getting a huge price to book premium as we earlier saw. Contingent liability for Vedanta is very huge at around 33,000 crores compared to its net worth of 56. So then I would avoid Vedanta because I'm not very comfortable where the contingent liability exceeds 20% of the net worth. Whereas in the case of Coal India, there is no contingent liability, or at least it's not shown here. NMDC is also reasonable at 4,677 crores. it's around 20%, slightly more than 20%, but still reasonable. In terms of debt to equity, Vedanta's debt is 0.8 times its equity, which is high, and therefore coverage is also very low at 3.36 times. That is below my benchmark of 4 times. Coal India's interest coverage is high because the debt itself is very low. NMDC's debt to equity is the lowest at 0.02, almost debt-free company, and it doesn't have to pay any interest coverage. Why it's showing is negative is because it has excess profits than the reason it is showing negative is because it has received interest instead of paying interest. So you can ignore that. This is not a problem for the company. Promoter holding is high for all of these three, with Vedanta pledging 99% of their shares as of the latest report. So this is a complete no-no for me for Vedanta, whereas Coal India and NMDC have no pledge. Debtors to sales is still reasonable for all these companies, lowest for Vedanta at 4.4% compared to Coal India at 23% and NMDC at 20%. So we want the debtors to sales, that is how much payment is still to be collected from the customers against the current year's sales done, is less than 30%. This is what is my benchmark. Debtor days or collection days is very high for NMDC at 69. Vedanta collecting very efficiently within 11 days, although 99, almost 100% of it is pledged. So this needs to be understood as to why they have pledged maximum of their shareholding. What is the reason? Coal India's collection days is around 54. NPM margin for all of them is above my benchmark of 10%. Highest is for NMDC at 30. So this will need to be rechecked whether it is consistent enough over the years to earn 30% or around that, or it's just a one-off value. Coal India's NPM margin is around 17, so this is a good value. Dividend yield wise, all three companies are paying a good dividend yield to the shareholders. Vedanta 6.9%, Coal India 8.9%, and NMDC 4.9%. So these are all good values. Let us look at the shareholding pattern for Coal India. 66% held by government, FII is 7.1, DII is very bullish at around 21% in the company. DIIs would also include insurance companies, so that has to be taken into consideration. And public is very low at 4.6%. You'll need to recheck all of these numbers once again on your own once you decide if you want to buy into this company. Let's move on and look at the relative strength index. If you look at the RSI indicator for Coal India, the actual time to buy into this company was when it dropped below line 30 on RSI, which was at a closing price of 131 rupees. This was the time to buy, and currently also it is available at around 133, so not very far off. From here on, I expect that it will go up 50% approximately from here on. So from here on, one needs to buy going downwards or a little bit upwards as well, if it doesn't give you that opportunity to buy downwards. According to me, one can buy up till max to max 155, and from there on either buy a little bit upwards or buy a little bit downwards, or go buying downwards. Don't buy everything at 130 or 131 rupees. Spread out your investment going downwards and little bit upwards, but not way too high. Max to max, as I mentioned, 148, 155. This is how I would buy into Coal India. I would also wait for a little bit opportunity towards the downside and then decide. But as of now, as I mentioned, 127, 148 and 155 are good price points to buy into the company. From 155 there is a breakout till 212 rupees approximately, where it will face some kind of resistance. Kindly do your own research, understand the fundamentals and then invest. Don't depend on any tips. Even when I mention that these are the prices, that these prices are for me, I would like to buy it in this manner. You need to do your own research and then come to a conclusion as to where you can buy and sell. This concludes my video analysis of Coal India. Thank you very much for watching this video. If you like, kindly consider subscribing and sharing it with your friends. Thank you very much. Have a nice day.